Hey, everybody, and welcome back to the Collective VC podcast. Today, we're joined by Dessi Pettersson. She is head of impact at Sagana, which is a climate focused VC firm with a thesis that spans Europe and Africa. Dessi, it's really, really awesome to have you on. I guess to kick this off, and maybe you can correct the introduction, talk a little bit about Sagana, about the thesis, and your role there.
Stage climate tech VC, investing out of the first fund at 8.5 million euro. And with that, we're investing 70% of the committed capital in Europe and 30% in Africa, with the long-term mission of building a bridge between the two climate ecosystems. So we really envision connecting more founders, LPs, technologies, and building more of a bridge between these very vibrant ecosystems where there is a lot of interesting things and exciting stuff happening, but there's a lot more room for cross-pollination and learning from the differences between the two different markets. And about my role there, so as a small fund team, we're 3 people full-time on the core team, and then we're supported by a broad group of venture partners. But head of impact basically means owning the SFDR work, so the EU regulation, Sustainable Financial Disclosure Regulation, never gets more easy to say that one. So we're an Article 9 fund, so I lead the work on that front, collecting all non-financial data from our portfolio companies, organizing ESG and impact-related workshops, and making sure that we help them build the impact muscle over time. But in addition to that, the privilege of being part of a small fund team is that you're involved on everything. So from fundraising to deal sourcing to the diligence, portfolio support. So it's really, I'm very privileged to be able to wear many different hats on a daily basis.
Sounds like a super varied role. I'm curious, you spoke about cross-pollination. Do you guys actively facilitate collaborations between your portfolio companies that are in different regions? Or do you just sort of have like a systems level approach when you deploy capital?
So I think there's a few different angles here. Some of our European portfolio companies are interested in the African market, and even though it's not their beachhead, they see they're curious basically if it could make sense to expand to Africa at some point or partner with someone there. So in that way, we can offer, okay, let's speak to our founders or to people on the ground there to kind of allow for that early market research. We also actually have one portfolio company that is based in Belgium, but that has their DAC facility in Kenya. So that's a very direct crossover. And then we also really enjoy connecting our African entrepreneurs to our network in Europe because we're supported by a broad base of LPs, primarily from Europe. And so that's another way we see it. And then I think another strength that comes from this strategy is really because we're able to see how our European portfolio companies are doing in the market they're operating in and kind of compare it to our African portfolio. We also really understand that the VC model is very different how it's working in Europe and in Africa. It's 2 very different markets, it's 2 very different market environments. That helps us understand how to be, or gradually understanding how can we be more relevant and a founder-friendly investor in each market. So over time, that's really where I see that we're going.
Yeah, what are those differences? Let's dive into the differences between VC and Africa and Europe. If I'm correct, that's actually what you did your master's thesis on, right?
For sure. So I wrote my master thesis on that, and that was when I was first joining Satgana. And I think tried to have a very open-ended and exploratory approach when I went to Kenya for 6 months and started conducting this research. Although I do, in hindsight now, realize I was quite optimistic about it, thinking, okay, it's an asset class that allows you to rapidly mobilize private capital from developed markets and allocate it to entrepreneurs in Africa. That seems super needed and relevant considering the climate funding gap and just the funding gap in general. So I was quite optimistic about it, but then started just first of all learning more about the history of VC, like as an asset class in itself, how it was developed after World War II in the US as a way to kind of spin out technologies from the war, but at very like high risk, high reward outcome. So that's really the nature of VC, as I guess many of your listeners know, that you're betting on a few to kind of return your whole fund, and that's the name of the game. But I think it's important to remember that while that asset class started taking form in first the US and the Europe, then a lot of the infrastructure was already in place. A lot of the traditional businesses and fundamental elements of the economy and the society were in place that allowed for these success stories of Microsoft and Apple to kind of have those 10 to 100x returns and scale very, very quickly, which is what every VC investor wants. While I think in Africa, it definitely still serves a purpose, as risk capital is very important to get to the continent. But I think it's important to recognize that a lot of the fundamental elements that VC builds on top of is still uh, missing to a certain extent in Africa, which means that you just need to think about what businesses are fit for the instrument here, and then also how can you adapt the instrument to be adapted to be better fit for the market. So I think that's a very interesting conversation that's going on in the ecosystem here in Kenya, where I'm based. How do you kind of reach like a capital stack that is more and more sophisticated, just like the one in developed markets, that allows VC to come in at the right time and at the right place and for the right founders, but also that you have supporting capital, supporting capital stack and investment instruments to make sure that, it's being used in the right way, if that makes sense.
And in terms of, so you're actually on the ground in Kenya right now. What does that look like in the innovation ecosystem and how capital is accessing it?
Yeah, I think it's an amazing ecosystem to be part of. So I was here for 6 months last year, and now I'm back. And it's really one of these vibrant hubs where you have VCs, you have family offices, you have all kinds of entrepreneurs. Like I think here is a very like just in the market, a very hustling environments. Many Kenyans have that hustling mentality and want to solve the problems they're facing by themselves. And when you walk into these events, which are basically every week climate tech conferences or VC startup pitches happening, you really feel this vibrant ecosystem where it feels like an upward trend. There's optimism in the room. There are people trying to solve solutions, capital trying to meet founders. I think it's important to remember that the ecosystem is still quite young. So VC has been Africa really only for 10 years is when you see the numbers really taking off. So knowing that VC is a long-term game in terms of exits and building track record, it's still in its forming days. But I think that's also what makes it so exciting, because you're part of building something. You're part of those early conversations of what is working and what is not working. And I'm so impressed by the entrepreneurs I meet there, because it's really, it's a difficult market to build in. It takes time. You need to be patient. There's a lot of more building around your core product or service that needs to come into play. But people do it with a smile on their face, and the opportunities are also incredible because there's so much that still needs to be built. So the ability to really have real financial and non-financial impact here is also, in my eyes, very exciting.
Would you think climate kind of dominates the conversation when it comes to VC in Kenya, or is there also a lot of more generalist investing going on and startups popping up in different spheres, or what sort of share do you think of the attention climate has?
I think definitely it has a big share here, and just as an example, when I was at Africa Tech Summit now 2 weeks ago, kind of had two main stages. One was the blue stage, fintech, and you had all the fintech guys, and you had the green stage and the climate. So it's really, I think, those two like big sectors that dominate, but then there are many that falls below it. So it can, I mean, within climate, you have energy, you have agriculture, you have transportation. So there's a lot that comes under that. And within fintech, you also have a broad range of products and services that fall in that realm. And I think kind of important to mention on the climate side is that here you also what's happening in Europe in a way, but here you really cannot get away with charging a green premium to your customers if you're a startup, because with lower purchasing powers and income levels, that really doesn't make sense. So you both need to think about the innovation itself, but even more the business model and how do I go to market? How do I make sure that I'm cheaper and also higher quality than the status quo? So I think that's also where we see that it maybe doesn't need to be a deep tech innovation here that is going to be the most interesting one. It's actually going to be a startup that has cracked, okay, how do I deliver something that is environmentally beneficial compared to the status quo, but also cheaper, or also gives an under incentive to the customer to buy my product. So there is really where I think there's a good nut to crack for everyone.
I think it's interesting you touched on the two different stages, like fintech and climate, especially because you previously mentioned that we need a more complex capital stack, and that's kind of I think that that's a nice segue here because so much of climate needs to have this relationship with fintech, and you need to look at these sort of innovative financing models between different sectors. How do you see like finance more broadly in Africa, but specifically VC needing to evolve to just service the needs of the ecosystem better?
Yeah, I think it's really about thinking about the range of companies out there that needs to be built, from the MSMEs and the to the like new traditional businesses, and like recognize that each type of business and what they're doing needs a certain type of investment instrument to match their needs. And then of course you cannot have a one-to-one fit with everyone, but really understand where are the big gaps in the market, what types of businesses needs to be built and also has the opportunity to succeed there, and then have a um, bottom up approach to investing. So how do you match that? So I think one side is just looking at the capital stack as this kind of different pages in a book, and like how do we get from A to Z in a good way. So you have from family to friends to grants to mezzanine financing to VC to private equity, and all those capital or all these investment instruments that exist in developed markets, making sure that those are also in place in emerging markets to fill the same function, but also recognize, because of the state of an emerging market which is different, what kinds of hybrid forms needs to take shape to kind of bridge the gaps between the businesses that needs to be built. So for example, thinking, what would a VC investing like a PE look like that would have another risk return profile and kind of be a bit in the middle between investing in these super scalable SaaS models, but to a traditional businesses, and how would you then structure that model and provide a compelling investment argument to an LP? So I think it's very much first complementing the capital stack so it just becomes more sophisticated and reaches the level of a developed market. And then once that comes into place, thinking, okay, what kind of new animals or new forms do we need to create here in the middle to really reflect the state of the market? And the second thing that I really think everyone here is talking about is a reoccurring topic is the topic of exits. So how do you create more liquidity in the market where IPOs are not only scarce but almost non-existent so far? I think they will come more and more with time, but you cannot only rely on those kind of quite rare occasions to happen. You also need to think about secondaries fund and how to create more liquidity for the early stage investor to avoid capital being stuck in a way. And even if a fund manager sits on well performing assets, how does he get out and how does he circulate that capital back to LP so they can invest in a new fund? So I think you also have that kind of second layers, because I think it's really like thinking of finance as infrastructure as well. How do you have a functioning finance infrastructure that allows each and every little actor to perform as good as he wants or can?
Yeah, I've been thinking about this a little bit. So I'm working with a company in Estonia right now, and in the case of Bolt, which was an Estonian unicorn, they were kind of deciding which would be the ideal exchange to IPO on. Is that a kind of challenge that African startups that kind of reach that status? Do they have the luxury of making that choice, or is it a toss up between thinking of whether or not IPOing is the right decision at all, or whether or not they even have the capacity to IPO? Yeah, what does that decision process look like?
Yeah, that's a good question. I think first of all, good to mention that I'm in the pre-seed seed stage, so
Okay.
haven't experienced it personally myself. I can imagine at the point where that if an IPO the opportunity presents itself, then it's just, I think, a discussion between the founder and investors, and also what is the long term goal of this company. And I think the same question applies when there is potential acquisition offer on the table. Do you want that and kind of cash out, or do you want to keep building your business? And how do you then align that interest with those of investors? I would say, yeah, I think that it's still very much a founder to investor topic, and also what is the interest of the founder to where does he want to go with this company when he has reached that state.
Sure. Okay, so let's bring it back to early stage. So I got a little bit ahead of myself. It kind of looks like there's 6 thesis focuses, those being mobility, energy, food and ag, industry and buildings, carbon removal, and circular economy. Do you pay any particular attention to any one of or a few of those as an investor yourself?
Yeah, good question. So our thesis is, if you look at the EU taxonomy's kind of main environmental objectives, there are 6 of them, and we have decided to primarily focus on climate change mitigation. So everything that avoids or removes GHG as the main focus of this fund. And then we see that we do that across sectors, so the ones that you mentioned now, because there can be solutions in all of them that contributes to this goal. And then as a secondary goals, we have climate change adaptation, which we see is increasingly important in emerging markets, also more and more in developed markets, and also transition to circular economy. And the reason for having that kind of broad thesis now is to get exposure and experience in all of these different sectors, both to diversify and then also to inform our strategy for future funds. So what that means is that we try to have a balanced portfolio where we make a few investments in each of these broader sectors. We would never invest in direct competitors, because when we back a founder, we really back them and don't want to feel like we have vested interest with potential competitors. So that's a key rule for us. And then also keeping in mind portfolio risk, for example. So avoiding having too many startups relying on the voluntary carbon market, for example, for its revenues. Not discarding it, but making sure that, okay, how do we make sure that we are spreading our risk across different sectors in the most promising technologies for our theory of change.
How does your sort of portfolio construction method reflect that theory of change? Because I like that you mentioned you don't invest in direct competitors. I've done some work with very, very dispersed funds, and that's not a problem to them at all. And I'd always be of the opinion that applying more effort and helping a founder more directly is always a better option. But yeah, how does that relate to your broader thesis on delivering change and making an improvement in a particular area?
Yeah, so I think how we look at startups now. So for context, we have made 20 investments so far, 6 in Africa, 14 in Europe. So in the beginning, when you have that broad thesis, you can kind of think the world is my oyster and you can pick very freely. But then as you go, you kind of see, okay, which countries have I already invested in? Which ones would I want to gain more exposure into because of I just want to learn more about the market. I want to have a relationship with founders. So you kind of identify key countries, and also very much from the point of view, where can I help? So where do we have network? Where do we have LPs? How can we be value adding? So that's really something that informs. Also, when we decide to look at a deal, is there something we can do here to help them out and to kind of highlight there what is, I think, quite unique about us is, even though we're very small fund size, we're not very small. I think for a first-time fund, 8.5 is a great achievement. But we have 150 people, LPs, backing us with this first fund, which is an amazing asset, actually, because we have such a broad group of people with a vested interest in our portfolio companies. Yeah, I think that's something you were speaking more about how we do portfolio construction, but the reason I'm mentioning this is like, how do we take the resources that we have, which is in a way our LP network, where do we have most experience, and then we map out which countries, which technologies, which sectors are the ones we want to gain exposure to now with the first fund, and then thinking very actively about how can we use these learnings, these networks with this first fund to inform future investment strategies. So really having that long-term thinking in mind, and like, where do we want to go by 2030, 2035, and really always coming back to the theory of change, which is basically, why are we doing this? Why are we investing in climate? How can we be the best climate investor possible, given the market and how it's developing, and balance diversification with support, with risks. In short, but that was a long answer. It's an ongoing balancing act and conversation.
And when you try and draw on these insights, you have like a specific platform role or gathering learnings from one startup and applying them in a new place. I think that's something I'm really fascinated in. And it's a complete gear change from the shotgun approach I see, being super common at early stage. So
yeah, I think now I'm the youngest in the team, but the GP and the partner can just really share how impressed I am by them, in the sense that they have seen so many deals, like on a weekly basis, on a year-to-year basis. At some point, you become really good at pattern matching, and you see many startups with targeting a similar problem, for sure, with a similar approach. Also, yes, and really digging deep into what is the secret sauce that they're offering, and what is driving defensibility. And then once you're convinced, you invest, and then you can also really think about what are the pitfalls of other startups in this space before them. How do we kind of highlight them early on and make sure that they are aware of them and we can help them mitigate them in time? I think many founders already know that kind of building their business case around subsidies or government policies is becoming more and more risky. So that's more common knowledge now. But I think the value of pattern matching, and if you really go down the kind of career path as an investor, is really that experience that compounds over time, when you've seen enough success stories, enough failure stories, enough kind of in the ground and unexpected events, and then you slowly start to make sense of what are the key success factors and what are the kind of both anticipated and unanticipated pitfalls that we can try to avoid.
And in terms of information processes, do you have like direct lines of communication between your LPs and your portfolio companies, or do you try and do that sifting yourself manually, or do you have any way of kind of really identifying who can help drive value and give insights?
Yeah. So how that works at the moment is that every time we do a new investment, we do an LP newsletter, so that we share quite in depth, almost like a high-level investment memo of the problem, the solution, the team, but also their needs and asks. So really encouraging LPs to have a look at how they could help. If you know anyone in in electric transportation in Europe, please connect. It can be these kind of call to action. And then oftentimes you also, a little bit acting like the spider in the web, already knows who would be a good fit for the founders to speak to. And sometimes it could also even be another founder, because sometimes the needs and the ask is more on a founder related topic, and then actually another founder could be the best person for them to speak to. And then we also have annual meetings where we gather all our LPs and portfolio companies, where online then, that is, and the portfolio company then can present their idea, where they stand at the moment, what has happened since the point of investment, and how LPs can help. So that's something we're also doing. And in addition to that, also some LP to LP matching, because we've seen that has been very appreciated by LPs to actually, people maybe invest like angels next to the fund, or they have an interest to learn more about climate, and then they're actually really interested to talk to other people in their position. So that's also been really nice when we made good connections there, and the feedback is, oh, this was a great coffee, thank you.
Awesome. So if you can share any examples, I don't know, what you can really speak about, but in terms of spotting patterns between, strong investments, just particularly in Africa, I'm quite fascinated about. Yeah, what are you seeing is working really well? Are there any key learnings that you've thought have been, really beneficial that you could potentially share on here?
Good question. I think what immediately comes to mind, but that also actually applies to European startups as well, is founders that have really fell in love with their problem. So they didn't look for a problem and they wanted to be an entrepreneur, but they have industry experience or experienced pain points somehow firsthand themselves, and thought about the solution long and hard before actually launching their startups. I think that becomes very clear when somebody has kind of, just done a few months of research and they're very capable, or someone who has that deep understanding and experience of, this is what's not working, here's what I think can work. And I think especially in Africa, having that understanding of like consumer behavior, like how to navigate politicians and regulations, how to think about kind of marketing your products to the broader public. There's so many of these nuances that as a foreigner is difficult to pick up, at least in the beginning, and you really need to spend time in the market to understand, okay, how do I really differentiate myself and how do I structure my product and service in a way that makes sense to this target market, and that could be different than your European assumptions. Um, and then I think kind of the key thing here, which I find very powerful with many of the African startups, is that they have this deep commitment to wanting to drive positive change on the continent, like really seeing themselves as a cogwheel of the broader machine. Like, I want to be part of driving change here and contributing to employment and other startups to get inspired. It's really this more system thinking in a way, and I think the founders that we meet that have that genuine drive to be part of building the economy and society and get those positive flywheel effects going. Um, they're the ones that are most resilient and kind of keep pushing. And also because many of them, they don't in the same way have a backup plan. Like, you have a European founder who will give it a go for 1-2 years, and then if it doesn't turn out, they'll go back to a corporate job or something else. But in Africa, you find founders who's like, this is their only shot. This is really their baby, and they will not let it go. For better and worse sometimes, but it's really a very inspiring conversations that you have with founders here, how they are so committed to their cause. Yeah, which I think is a great success ingredient.
You're so right that like you can definitely sniff out when people are just obsessed with the money from the get-go, and that's no reason to start a company, especially in like an impactful space, right? You need to have that passion that's like not to say money is important, and obviously it's it's a livelihood for somebody who really needs it and who doesn't have a plan B, like you said, but you really do need to make sure that passion is well communicated. I'm wary, obviously we're talking about Africa quite broadly as if it's not a huge continent. Through being in Kenya, do you think Kenya as a hub allows you to meet people from all over the continent? Because I've noticed that you've invested into Tunisia and other African countries. So how do you make sure that you're getting that geographical distribution and learning about the continent as a whole and all of the intricacies?
Yeah, no, a really good question. So I think first it's important to highlight that roughly 80% of all the VC funding that reaches Africa goes to the four big markets. That's Nigeria, Kenya, Egypt, and South Africa. So that's really the ones receiving the main bulk of it. And how that is for us is that in Kenya, I'm based, and that's really a big hub for VC investments on both the climate side, but also on other sides where, yeah, as you mentioned yourself, a lot of people meet and you kind of learn from experiences from other markets. But also a key takeaway there is that it is very different from other markets. So even going from Kenya to Uganda is a very different thing, or Kenya to Rwanda, because you have different governments, you have different consumer behaviors. Like, it's not as easy as going from Netherlands to Belgium with your business. It's really like demands that on the ground knowledge and people that can help you with that kind of scaling. So I think that's a key learning. And for us, the GP of Sagana lived and worked 7 years in South Africa, so he has a good network there and a broad understanding of the market. It's actually there now for a few weeks to do some in-depth due diligence of the startups there. For example, in Nigeria, which we recognize to be a very big and vibrant market as well, that a lot of interesting startups there. But because we don't have people on the ground and not that kind of partner that can help us with the diligence and scouting and just understanding what you said, the intricacies, we actually are not focusing on that region now, but we will for future funds, because we recognize the importance of having that on the ground knowledge, network, experience, because many things looks good on theory, but in practice it can be completely different. So it's very important to have your kind of allies on the ground and a local understanding to make sure that you're making investments that make sense, but also that you can support your portfolio company.
You guys are writing pretty big checks, right? Like in the hundreds of thousands of euros.
Yeah, so the average first ticket is 100 to 350K in the pre-seed seed stage.
Okay. So, I mean, how does that impact the diligence process? Because it's amazing to meet people in real life, and you talk about having people on the ground in the target country. But yeah, because I found it pretty crazy when I came into the VC world and I started doing analysis that there are funds who will wire a check after like a few Google Meets and like a diligence process, on a shared document, right? And that's like the complete other end of the spectrum to
Yeah.
you guys who are actually going and meeting them. So yeah, what is that? What are the sort of timelines? How do you make sure you have that conviction? Do you have like an investment committee? Like, yeah, how does that work?
Yeah, so I think one, it's important to note that for some we kind of do have the ability to come and visit them in person and have that in-person connection, which is always preferred because it's super nice to get to know each other. It's We kind of keep joking that investing is like being married. It's really like a 10+ year commitment. So ideally you want to meet before the altar. But you cannot always do that. And also for us, even though 100 to 350K is a good ticket size for the pre-seed seed stage, we're actually often a follower investor because there are um, other funds on board that are bigger and take the lead position. So I think how it works for us is on a deal by deal cases. We try to meet the founder or speak as much as possible online if that's the only way, and then work a lot with the co-investor. So or you have customer reference calls. So really do as broad of a research as we can while partnering with other potential investors on the cap table because for example, for our portfolio companies in France, we have the ability to meet more often. For the ones where we don't have any person on the ground, it really relies on this honest, open communication after investing. And in the due diligence phase, it's really just going through our investment process. So, in short, what that looks like, we get a deck either from applying or from another VC or from a founder. We do the initial screening to mix in to see if it fits our geography, thesis, stage, all of that, and also the impact consideration. And then kind of the pre-due diligence phase starts. If we first we have the first call to do the initial kind of feeling: is this a fit? Can we move on? Timeline. There are so many of these aspects just to make sure could this potentially work even from a round dynamics perspective. And then we enter the pre-due diligence phase, and then we do yeah everything from the data room to customer calls to investor calls, and that kind of slowly progresses into the deep due diligence when we have the final ping pong of questions or meet in person, and then we aim to be able to invest around from between the first call to the final offer 2 months roughly to have all the information we need. And that also depends on closing times of the startups because sometimes they come in and they are only a few weeks to close and you need to move really quick. For a few, you kind of start the conversation in the beginning of their fundraising, and then you have the privilege of kind of monitoring it over time. So while it's good to have standardized timelines, it's also very good to be flexible and recognize, okay, move quick, monitor, but at all times try to be very open and transparent with the founder of this is where we stand, this is what we can commit to in terms of time.
I'm kind of just trying now to imagine you explaining that to the B Corp team. Like, how did that happen? I've never seen a VC firm obtain a B Corp status before. I'm not sure if you guys were the first. That might just be a complete ignorance on my part. But yeah, what sort of questions did they ask? Were you involved in that process? Were they familiar with the function of VC and how it typically works?
Actually, it was before I joined the team that Roma kind of went through the whole process, which I know was a long one
That's
with
cool.
many questions. So I haven't really been involved with the B Corp certification, but now kind of I'm in contact with the B Lab community. And I think it's really the what we wanted to do with that is I think the B Corp really symbolizes the ethos of the company and also like the internal governance and what are you trying to achieve. So I think for Rama, who when he started the company, he was really keen for everyone to know that this is a force for good and that Sagana should be a catalyst for positive change. And then seeing SFDR Article 9 and the B Corp as those kind of signals that you can communicate to all your stakeholders, saying we're really taking this seriously, we're committing to the highest standards, even though it takes a lot of time and resources for a little fund and a small team. But going through the process and just being very transparent, this is why we're doing this is what we can realistically do as a team. And yeah, very happy that it went through, and then it requires quite some work and continuous reporting to kind of uphold the standard. So that's something that's coming up. But yeah,
that was going to be my next question in terms of your ongoing responsibilities from the, I guess that's a voluntary thing, but in terms of general compliance and measurability, what does your sort of ongoing responsibilities look like?
For me personally or for B Corp?
I guess, I mean, as head of impact, I guess you'll be handling that, but not just for B Corp in terms of all of your, I would say that you've gone above and beyond because there are so many firms that are not Article 9 VCs, right? So in terms of taking that extra step, what are the actual ongoing commitments there?
Yeah. So I think that's been a very interesting learning experience, because I think the SFDR definitely serves a purpose, and it comes from creating more transparency in the financial market. So people can actually see, or LPs can see, where is money flowing and what is the commitment of that fund manager to environmental and social objectives. So I think the transparency is kind of step one, and then change comes after transparency when you actually know what you're dealing with. I do think that the SFDR, and this is an ongoing conversation in the early stage VC ecosystem, but it's really not tailored for early stage companies. So startups that you invest in, you kind of ask them questions on, are you aligned with the UN guiding principles for anti-corruption? You know, there's all these higher principles that make sense, but are maybe more applicable when you're a big corporate, or where you are bound to those more transnational regulations and commitments. So there is a lot of kind of thinking around how could you make the SFDR more customized to early stage investors and early stage investees, so that the questions you ask are actually appropriate and make sense. Because you have, in the kind of questionnaire, you have like on carbon accounting, then you have a lot on these different principles. And I think it's important to recognize that these questions, some of them we need to ask, and some of them are also part of building the muscles in terms of good governance in the long run. But it's also what we hear from portfolio companies, many of them that are not relevant yet, and then you're kind of stealing time from them, asking them to do a lot of excess reporting on things that are not yet material to them. So I think how we are doing it now is that we're really trying to support them on the carbon accounting side, but also recognizing that for a small startup to have full overview of their scope 3 emissions is very challenging, and maybe not the top priority when you're trying to build out your product and service and find product market fit, that you're going to try to estimate scope 3 emissions when big corporates are not even doing it. So finding that balance between definitely asking questions and putting into practice that these non-financial topics matter, but also as much as possible trying to influence the policy space. So I'm part of the United for Impact group, which is amazing in driving just collective action, in a sense, pooling insights from all VCs, saying this is what's working, what is not working, to kind of adapt it to each asset class that it targets.
Do you think there is a good feedback loop with policymakers there in terms of listening to, like you say, that very valid early stage complaint that, that's a huge burden on young companies looking to make a change to be thinking about their scope 3? Is that something that's been received well?
I think so. Now the current regulation is currently being reviewed and kind of reevaluated. So for sure there is some concerns have been heard, but then as with every kind of EU-wide regulation, it takes time, and there's a lot of things that needs to come into place before you actually make a change. And in the meantime, you have a lot of uncertainty. Is there going to be a change or not? And then how do you kind of, when you need to comply with a regulation that is still a bit moving, then what you can do is just, I think, comply, learn, and report back, because that's also how early stage, or that's how we also develop the policy landscape. So I am hopeful that there will be a bit of a refined version for this specific group, because also what's important to recognize is like the SFDR is really targeting all financial market participants in the EU, but for climate tech investors investing in early stage startups, they're already committed to having a positive impact. So then the questions and what you're asking from them should reflect that and not take that very, very general approach. But the risk there is that if you go too far on that loop, everyone wants to have a little customized thing for what they do, and then that's also not sustainable. So finding that balance act again between reporting, building non-financial reporting skills from the early days, but avoid overburdening startups too soon, too much.
I think voluntary carbon kind of proves what happens when you kind of leave private sector to set standards to itself. So I definitely agree that there's a fine balance that needs to be struck. You touched a little bit on anti-corruption, anti-bribery. Now, I'm wary of having like a kind of essentialist viewpoint towards the African continent, but is that something that plays into your decision-making kind of process more than, let's say, a European VC firm or a VC firm that's not looking at the African continent? Because, like you said, it's a difference in just hundreds of kilometers. You can go to a new country, and then there's an entirely different regulatory stack and different stakeholders and all sorts of cultural norms and practices that you might not be accustomed to. Yeah, if you could speak a little bit on that, that'd be really interesting.
No, so I think there it's very much more about being aware that our African entrepreneurs are in a market where you just need to be more wary of those risks, so that they face they have higher risk of facing kind of corruption and these risks than European portfolio companies. But in the end, as an early stage investor, you're really again betting on the entrepreneur and his integrity and authenticity. So like understanding, okay, between us there's going to be an honest and trustworthy relationship, and then from there, when we're invested in investor, as much as possible understanding, okay, is there a risk here for corruption? It can be in the company if they scale very quickly, and how do you manage that? But also, and specifically from the external world, and how can you then help mitigate those risks? And that's something, to be honest, that we're still very much learning from others. And it's still like, if you could end corruption, I think we would have by now. It's really like a disease to get it out of a system or market. But I think as an investor in the space, it's really about having that trust and belief in your founding team. And then once you invest, being that trusted partner. So when they face those risks, or when there are, if there are, incidents, that you can be there to kind of help mitigate or manage before it goes too far.
And I think there's a huge sort of misperception of corruption in that sometimes it's just like, a bunch of kind of cronyism and corporatism and people kind of just pulling levers to benefit themselves. But from the perspective of a startup, you've got to assess that almost as just like a regulatory bottleneck, right? There's an obstacle in the way, and it's somebody who wants to game the system, overplay their hand, bend the rules, and ultimately the startup's the one who's in a sticky situation, right? So what sort of, I don't know if this is your area of expertise, but in terms of being in the startup shoes, what are the options on the table? Legal recourse, do you guys offer that sort of support? Or
so that's again one of the topics that makes it so essential to have your founders and their teams on the ground. So I think really trusting also the like sometimes you see, foreign founders that come in and maybe don't have that local market knowledge, or you have also some foreign founders that are in Europe and trying to drive their business in Africa. There we really see that as a risk, because we do think boots on the ground, local partnerships, local relationship to lawyers, local relationship to people in policy, because I mean there are also very many good people that are trying to support the startup ecosystem there, is key. And that also depends on, if you're a DAC company in Kenya, or if you are a EV startup in Ethiopia, it all is so context dependent on the country you're in and also what you're trying to build and what are then the risks around it. So I think having that context specific approach and betting on people that know their market really, really well and also know people in the market that can help them hedge these risks really, really well is something we look for in our due diligence phase, not claiming that we will have the answer and solve all these risks for you, but we look for founders that can show we are aware of these risks and we're going to do XYZ to try to mitigate it. And we have done XYZ in the past, experienced similar things, which makes us believe that, okay, you're equipped then to, or better equipped than someone who haven't had that experience or connections to do what you're doing.
So I guess let's switch now just to broader climate trends that you find exciting. Is there anything in Africa that's you're really looking at and thinking, I need to just go down this rabbit hole and examine every single corner of this? For me, like as soon as I get obsessed with something, I do like a deep dive on that, and I sometimes get lost in them, and I feel like it's kind of better maybe just to stay on the surface a little bit and try and see more broadly.
To be honest, I would love to go down every rabbit hole from cold chain storage to microgrids to energy management systems to adaptations. There's so many amazing opportunities here where you can see that, yeah, as mentioned, so much that still needs to be built. And there's also a lot of startups out here that, what I mentioned before, really reconcile the environmental benefit with cost savings. Also because for energy, for example, many rely on backup diesel generators and um, the logistics supply chain is often broken and inefficient. So there's a lot of these startups that are tackling inefficiencies or offering a solution where you actually the incumbent is also more costly and more polluting. So everything in that space I find super interesting. And in terms of doing deep dives, for us with the African side, it has been such an incredible like natural organic flow of the pipeline that we've had like one case that we dig really deep into because we're super fascinated by the problem and the solution and the founder, and then we decide to move forward. And then, as mentioned, we would then not do a direct competitor investment in that market in the technology. So that means that the next interesting deal, so it's more at the moment kind of the deals really informing the due diligence and deep dive, but every time we do that, then we naturally also compare this startup to other startups in that space. So let's say you get one like cold storage solution, then you of course also look what are other startups in this space doing, what is the differentiating factors, which one have most traction. So it becomes this organic deep dives at the moment. But I think what's going to be super exciting is for our upcoming Africa Fund 2 that is going to be coming up in Q3 that we're going to start fundraising for that. I think that's going to be super exciting because then we have the opportunity to do the theory of change for that fund again, to really think deeply about what problem do we want to solve in the African market? What are our inputs, outputs, impact? And then you can also really use that as your framework. What sectors fit both best into this broader objective? So I see that we're going more into those like structured deep dives, but at the moment has been just this amazing learning experience driven by the opportunities and the founders that we've met.
Mm. So it's almost like when you latch onto one startup, it provides a good entry point into understanding other angles of that ecosystem, right?
Yeah.
So without
Yeah.
asking you to choose a favorite, because I know it's impossible, could you maybe highlight like one particular startup that is a really good case study here of allowing you to learn about other things?
Ooh. Yeah, I think one startup that I'm just super, yeah, we invested before I joined the team, but I was always very fascinated by them. It's called Build Cubic. They're based in Ethiopia. They're turning difficult to recycle plastic waste. So they're working with informal waste pickers, and they're turning that waste into a low carbon building material that can be used for houses. So it's also providing affordable housing to the Ethiopian market, where I just find it such a stellar case of like social impact because you're working with informal waste pickers, you're contributing to more affordable housing, environmental impact because you're taking waste and turning it into value, and you're displacing cement, and you're really also part of like the manufacturing industry in Ethiopia, because they have a factory where this conversion process happens. And I also think it's such a case, one of the ones where in theory it's just like, this is too good to be true. Like, why are we not doing this at scale? It just sounds so amazing. And then over time, when you build a relationship with the founders and you just learn, like, it is just so difficult to set up a manufacturing company in Ethiopia and build scale on both supply and demand side, offtake agreements, secure financing. I think we're just so humbled to be investors in these brilliant, brilliant minds that know their market so well and have that deep commitment to driving positive change. As an investor, you're humbled when you hear their story and what they want to achieve, and you're kind of, can I support you on that feeling? Yeah, it's really amazing.
I'm just looking now. It almost looks like they were trying to tick off as many SDG goals as possible.
Yeah, exactly.
Just some follow up questions on this particular company. Are they doing like, I'm looking at a photo. I'll put it up on screen for the viewers. But is it like it's almost like a building technique where you try and interlock items to make like stronger? I think it's a Japanese technique where they slot stuff together. Is that kind of what they're doing here, or am I just inferring from an image?
Yeah, so that's they're turning the plastic waste and then kind of a new binding material. So that's what they can, instead of having to use clinker and cement, they can take this difficult to recycle plastic and kind of displace that. And I think it's important to also mention that the kind of building material maybe wouldn't be fit for European buildings where you need another type of protection against cold and so on, but for specific types of structures in Ethiopia, that it really makes sense. And also, again, like where the innovation that works here, it doesn't maybe necessarily fit the needs of the European market, but that doesn't mean it wouldn't be a great idea here.
And that's why you need that local insight, right? Otherwise, you're bringing all the wrong ideas to a new place.
Exactly.
What was the IP assignment process there, if you don't mind me asking? How did they get that trademarked, or what are trademarks and patents look like more generally in Africa?
Yeah, so I think it's a mix of trade secrets, and I think also, I don't want to speak about Cubic too specifically, but I think it's interesting in general to speak with some founders now, again generalizing, that actually don't want to patent their IP, because when you patent something, it also becomes visible to the public, which means that other actors can tweak it so it's similar but not exactly the same, and then use it. And that's where trade secrets and keeping it a bit hidden is better. It was actually something that it was a kind of a new learning for me in the last year, that actually sometimes you would not want to patent your IP because that actually is a bigger risk of a copycat. But then once you reach a certain scale, then you basically must to protect it. So I think that's also an interesting conversation to have, both on the European and African side, and that some founders have that see that as a big risk. It doesn't need to be European or Africa specific, but the fear of somebody trying to do what they're doing, and that's something that drives them a lot to kind of protect IP, not be too vocal about the details, while some don't see that as big as a risk, which could be depending on the strength of the IP or the strength of the networks or the partnerships. I think that's fascinating, that it can be a very broad range there, especially at the early stage, on how you view IP protection, and that it is a bit of a case by case and industry by industry influence.
Yeah, that's fascinating. That could be a whole podcast episode in itself. So yeah, I'm conscious we're coming off on time now. So I guess just as a final question, do you have any sort of advice or kind of final thoughts for people who are looking to start climate ventures or invest in climate ventures in Africa? What's something you wish you knew when you were getting started?
I think for me, it's still a super steep learning curve, which I'm very aware of. I think the advice I would give, I think to invest, people that would want to be exposed to climate investing in Africa, would be be super humble to the local market environment and really try to be as a sponge, like listen to people who have been in the environment longer, really like try to pick hole on all your assumptions, what is going to work and not work, and really as much as possible just try to take in. And then when maybe having a concern on a startup on a business model, for me, I'm always still trying to share it like, this is how I see it. What do you think? Not trying to have that like, I think I know better than you, because I'm very aware of being grown up in Sweden and educated in Europe. Like, there's no way I can understand the markets better here than a local. So really bringing that lens of openness, curiosity, wanting to understand, and also then okay, but from what I've learned before, I would assume X. What do you think about that? So really having that more of an open ping pong conversation, I think, is super, super valuable. Number two is keeping a child's eye on things. I think that's also something that can be actually the asset of coming as an outsider and new and kind of very curious and driven. Like, challenge things to things are not working and kind of ask the stupid questions that actually might be the right questions. I think that's something I'm very much still trying to do. Like, maybe this is a stupid question, but I just want to ask, always try to understand. Yeah, to not just accept things that you think that doesn't seem that they are the most efficient way that they should be. I think that's really important. And three, I think investing in Africa is one of the I think if you can do it well, in a well that really that you're founder friendly and can support entrepreneurs here build long lasting businesses, and if you can also do that in a way which shows to the private market that you're generating returns and that it's really has a return on investment, if you can crack that nut to do the both at the same time in a good way, then you're really part of building something extraordinary, because there's so many opportunities here. And not saying that a lot of things needs to be built in Europe as well, definitely. And we're in this climate change crisis together, and it needs all components. But if you invest here, you have the possibility to invest in mitigation, resilience, adaptation, socioeconomic development. It's really that holistic way of thinking that I'm really excited about.
Awesome. That's a great answer, and it's a good place to wrap up. I'll definitely turn that one into a clip. So yeah, thank you so much, Dessi. It was a really good convo.
Thank you so much, Ollie, for having me. It was great.